Silver didn't just break out, it exposed a pressure point in the entire financial system. And now the market is being forced to reprice risk in real time, whether the institutions want that repricing on the tape or not. Because what you're watching is not a cute precious metals rally, it's a chain reaction, where the people who manage volatility for a living are suddenly paying more to control their risk. The people who depend on calm pricing are suddenly losing that calm. And the people who thought they could wait are discovering the calendar is the one thing you can negotiate with. And later in this video, I am going to give you the exact checklist for the next 1 to 2 weeks. What confirms, what breaks, and what level matters. Because if that one level flips, the math changes. Here's what most people get wrong right away. They stare at the spot, quote like it's the whole story. It isn't. Spot is the headline. The real story is the plumbing. What the curve is doing, what implied volatility is doing, what spreads are doing, and what that forces hedgers and dealers to do when liquidity thins. That's where the pressure starts. And right now, the pressure is not subtle. In the last couple of weeks, silver has been trading up around the kind of prices that used to sound like a punchline, hovering in the neighborhood of $90 an ounce and whipping around with violent intraday moves that are specifically engineered by the market itself to shake out anyone who confuses noise with signal. It's not just up, it's up with chaos, and chaos is a message. Because if this were just a retail mania, it would look different. It would be loud and crowded and frothy at the edges, but the texture of this move is telling you something else is happening underneath. Let's talk about the conflict, because every real move has one. There is a side of the market that needs silver not to behave like this, not because they're evil cartoon villains, but because their job is to keep risk within limits. Banks, dealers, large hedgers, anyone running a book that depends on predictable hedging costs, those players are allergic to runaway price discovery. Volatility makes hedging expensive. Volatility makes margins rise. Volatility makes financing harder. Volatility makes committees nervous. So when silver starts moving like this, the system instinctively tries to compress it back into the box. Spreads widen, liquidity gets selective margin requirements bite, and the headlines shift from breakout to bubble to S over on a loop. But here's the catch. The market can try to suppress the expression, but it can't suppress the mechanism if the mechanism is real. And the next detail is what flips the whole setup. The hidden detail, the underappreciated tell that reframes everything, is that the stress shows up first in the time dimension, not the price dimension. Time is where physical markets reveal themselves. If a market is truly comfortable, the curve pays you to wait. If a market is stressed, the curve punishes you for waiting. Because time becomes expensive when availability is questionable, when delivery windows matter, when financing is tight, and when people can't just roll forever without consequence. So instead of obsessing over whether silver is at 87 or 93 in this moment, you watch the curve. You watch front-month behavior around delivery cycles. You watch the implied vol that tells you what it costs to ensure the move. And you watch the way spreads behave when the market is trying to ration immediate supply. That's the lie detector. And right now, the lie detector is humming. Let me make this clean without turning it into a textbook. Silver lives in two worlds at the same time, the paper world and the physical world. The paper world is futures, options, leverage, and positioning. It S where price can move fast because contracts are promises, and promises can be created in size. The physical world is inventory, refining, transport, fabrication, and real delivery windows. It's where price moves slower until it doesn't, until the physical clock forces urgency. The paper world can roll positions. The physical world can't roll a factory schedule, can't roll a procurement deadline, can't roll a delivery notice period without consequences. So when you get a move that has both speed and persistence, you ask one question. Is paper chasing paper, or is paper being dragged by physical constraints and calendar pressure? Because if it's the second one, you don't treat it like a normal rally. You treat it like a repricing event, and that's where the real pressure starts. Now zoom in on what repricing risk actually means here. In a calm regime, the market's risk premium is cheap, volatility is manageable, hedging is affordable, funds can hold positions without constant stress testing, dealers can warehouse risk and hedge it smoothly. But when silver ace implied volatility is screaming, when option markets are pricing in massive swings, hedging becomes a tax. That tax changes behavior. It forces dealers to hedge more aggressively. It forces shorts to think about margin risk differently. And it forces long-only allocators to reconsider what diversification even means. Silver is not just a metal in that environment. It's a volatility instrument. And volatility instruments change portfolios whether people like it or not. That's why this move spills beyond silver. It's why gold listens. It's why copper and broader commodity risk can get pulled into the same conversation. And the next detail matters more than the price itself. Watch what happens when volatility rises and margin pressure tightens at the same time. People love to say, if it gets too hot, margin hikes will cool it off. sometimes. But margin is a double-edged blade. It forces selling, yes, but forced selling doesn't always end a move. It often resets it. Because forced selling flushes weak hands, transfers positions to stronger hands, and reduces open interest in the most fragile places. Then, if the underlying driver is still there, tightness, urgency, fear of missing physical, fear of being short into a delivery window, the market can rip again into thinner liquidity. And that second rip is where rallies turn into repricing events. But that's not the part most people are watching. Most people are watching the headline narrative. The narrative will tell you silver is up. Because inflation, or silver, is up. Because geopolitics, or silver is up because a celebrity investor tweeted something. And yes, narratives attach themselves to moves. They always do. But the market doesn't need your narrative to move. The market needs flows, constraints, and timing. One of the most revealing tells right now is that while silver has surged, there's evidence that a chunk of U.S. retail participation hasn't been the eager buyer you'd expect. They've been more hesitant, even selling into strength in some pockets of the retail physical market. That's weird if you believe the story is the crowd did it. It's not weird if you believe the story is institutional and overseas flows did it, and retail is reacting late. And that difference matters because institutional flows behave differently. They don't stop because a headline says overbought. They stop when risk budgets get hit, when hedging costs get prohibitive, or when the calendar forces a rebalance. That's where the real pressure starts. So let's anchor the chart structure without turning this into a slow technical lecture. In any market, a breakout isn't just a line on a screen. A breakout changes who is forced to act. Above a major zone, sellers become risk managers. Hedgers become chasers. Dealers become delta managers. Funds that were underweight become benchmark sensitive. And when that happens in a market with thinner liquidity than people assume, you get air pockets. Price can gap because there aren't enough natural sellers at each level. That's why silver can drop hard and then recover like it didn't even happen. Those V-shaped recoveries aren't random. They what happens when the market finds out that the dips are being bought by participants who have reasons that are not emotional, reasons that are structural. And if you've ever wondered why silver moves feel like a trap, that's why. Because it's not just investors trading opinions. It's a structure trading constraints. And the next detail flips the whole setup. Here, S, where we get concrete, what should you watch right now to know if this is repricing or just a blow-off? First, watch the curve behavior around the front months. When the market is truly comfortable, the incentive is to sell nearby and buy deferred, to store and carry, to arbitrage time. When the market is stressed, the nearby months can trade too strong, and the curve can stop paying you to wait in the way you'd normally expect. Even if the curve is technically in contango, the shape and the spreads can tell you whether that contango is a healthy carry or a fragile premium, because the curve can look normal and still be screaming stress in the way the front end behaves day to day. That's the hidden layer. Second, watch implied volatility. When volatility stays elevated and price holds up anyway, that's a sign the market is paying an insurance premium and still refusing to back down. That's not retail emotion, that's math. Now, I promised you an actual mechanism explainer, so here it is in plain language. Options and dealer hedging can turn a move into a feedback loop. When a lot of calls get bought or when positioning clusters around certain strikes, dealers who sold those options often hedge by buying futures as price rises because their delta exposure grows. If the market enters a zone where the gamma profile makes hedging more aggressive, that dealer buying can accelerate moves. It doesn't create the entire rally from nothing, but it can amplify it, especially when liquidity is thin. And thin liquidity is exactly what you tend to get around certain calendar windows. Into contract cycles, into expiration, roll dynamics, into month end. The calendar is the catalyst. That's why a seemingly random day can suddenly become a launch pad. And that's where the real pressure starts. But don't get hypnotized by one mechanism. Proof stacking is how you stay honest. So let's stack the proof points you should be looking for without inventing fake precision. 1. Chart structure. Does silver defend the breakout zone after a violent shakeout, or does it slice back below and struggle? 2. Term structure behavior. Do front month spreads stay firm? Do they snap back quickly after stress? Does nearby strength persist? 3. Implied volatility. Does VOL remain elevated while price holds, signaling persistent demand for insurance and persistent willingness to hold risk? 4. Institutional and overseas behavior. Do the big vehicles and the global bid appear resilient even when U.S. retail enthusiasm looks muted? 5. Real-world symptoms, premiums, availability, procurement chatter, anything that suggests the physical market is not as relaxed as paper totals would imply. 6. Cross-market confirmation. Does gold hold up alongside silver? Do industrial metals stop ignoring it? Does the broader commodity complex echo the repricing? Each one of these alone is not proof. Together, they form a map. And the next detail matters more than any one headline. Now let reassess talk about the most common trap people fall into. They hear inventory, buy, and they think the argument is, there's not enough silver in the world. That's not how tightness works. Tightness is almost always about the marginal unit, the deliverable unit, the unit available at the right time and the right form. Big inventory totals can exist, while the actually deliverable float is tight. Metal can be in the wrong place, the wrong form, or tied up in financing structures that make it expensive to mobilize. Refining takes time. Logistics takes time. Contracts specify deliverability. And when those frictions matter, the market doesn't politely send you a memo. It expresses it through spreads, through financing costs, through behavior around delivery windows. That's the underappreciated detail. It's not about a dramatic running out. It's about the system's ability to meet immediate demand without paying up. If the system has to pay up, you get repricing. And if the system has to pay up while volatility is already elevated, you get violent repricing. That's where the pressure starts. Let's bring in the why now trigger, because timing is not optional here. January is a special month in markets for a few reasons. Positioning resets. Risk budgets get recalibrated. Some funds rebalance. Some participants come back from year end with new mandates and fresh capital allocations. Liquidity can be deceptively thin at times because not everyone is fully back to normal size at the same time. And then you layer in the futures calendar, contract cycles, roll windows, delivery-related deadlines, options expirations that can concentrate hedging flows. Put that together and you get a tinderbox, a market that's already moving in a window where hedging and positioning behavior can amplify moves. The calendar doesn't guarantee direction, it guarantees sensitivity. And right now, silver is acting like a market with high sensitivity. That's why the same price that looked expensive at 80 can look inevitable at 90 if the structure is right. But that's not the part that matters. What matters is what the move forces other participants to do. Because price is not just a number, it's a command. When silver breaks higher, it forces short sellers to reassess risk. It forces hedgers to decide whether they are comfortable being short gamma in a market with exploding implied volatility. It forces industrial consumers to think about procurement, hedging, and substitution thresholds. It forces portfolio managers to reconsider correlations. If silver is acting like a volatility grenade, it can change how you hedge equity risk, bond risk, and currency risk. This is what repricing risk looks like in the real world. It's not a philosophical debate. It's a chain of forced decisions. And the next detail flips the whole setup. Now, let's address the counterpoints, because skeptics deserve more than hype. First counterpoint. At high prices, industrial demand can thrift or substitute. Silver isn't magic. If it becomes too expensive, engineers look for alternatives, manufacturers adjust loadings, procurement teams renegotiate, and demand can soften at the margin. Second counterpoint, if the dollar strengthens sharply or if real rates rise, precious metals can get hit even in a strong structural setup because the macro flow can overwhelm the micro for periods of time. Third counterpoint, violent markets can overshoot and then mean revert brutally. And if you confuse overshoot for new normal, you'll buy the top and then blame the market for doing what it always does. Those counterpoints are real. But here, and guess the rebuttal, none of those counterpoints invalidate the idea that the market can be forced to reprice risk in the near term. They simply tell you what the invalidation and the speed bumps might look like. They tell you what to watch next. That's where the real pressure starts. So let's talk about what volatility will do to your mind. Because this is where most retail investors get robbed, not by institutions, by their own reactions. In a move like this, the market will use three emotional weapons. Weapon one is euphoria. A straight-up move that makes you feel stupid for not being in it, so you chase without a plan. Weapon two is the trap candle, a sudden violent flush that makes you feel stupid for being in it, so you sell at the exact place stronger hands are buying. Weapon three is narrative whiplash, headlines that flip from silver unstoppable to Sukkot, silver collapsing in the span of a day, timed perfectly to your emotional peak. Your defense is not bravado. Your defense is structure, trend signal versus noise. If the market is repricing, it will whip around violently and still stay above key zones. If the market is failing, it will lose those zones and struggle to reclaim them. You don't need to predict every wiggle. You need a thesis with a confirmation and an invalidation. Because if this one level breaks, the math changes. Now we get to the near-term roadmap, the part you actually use. In the next 1 to 2 weeks, you should think in two scenarios. Scenario one is the controlled pullback and retest. Price pulls back, liquidity thins. Everyone on social media screams, "It's over!" And then the market finds bids near the breakout band and starts grinding back up. That scenario is healthy. It shakes out leverage, it tests the market's ability to absorb supply, and it often sets up the next leg if the underlying constraints remain. What confirms that scenario? quick recovery after flushes, stabilization in the front end of the curve, and implied volatility that stays elevated without price collapsing. What weakens it? A pullback that becomes a breakdown, where dips stop getting bought and rallies get sold hard. Scenario 2 is the continuation squeeze. That's the one where the market doesn't give you the polite retest. It stays firm, pushes through recent highs, and starts gapping because sellers step away and hedgers chase. In that scenario, the risk is upside acceleration with sudden downside air pockets, because the same thin liquidity that allows gaps up also allows gaps down. What confirms that scenario? Breaks to new highs that hold persistent strength in the front months, and signs that hedging demand remains intense. What invalidates it? A spike and fade pattern where the market prints a new high and then cannot hold above the prior range. 2 scenarios, same discipline. And the next detail is what flips the whole setup. So what are the actual levels without pretending I can hand you a magic number that never changes? Think in zones and behaviors. One key zone is the most recent breakout band, the area that, if it holds on pullbacks, tells you the market has accepted higher pricing. Another key zone is the round number psychological area, where liquidity clusters and options positioning often concentrates. Those zones become magnets because large players hedge around them and because human brains anchor to them. The behavior around those zones matters more than the exact print. Does price snap back when it dips into the zone, or does it meander and bleed? Does the market feel like it's being supported, or does it feel like bids are evaporating? And if you want the fastest early warning signal, don't look at Twitter. Look at the structure. If implied volatility stays extreme and the curve refuses to relax, that tells you stress is still present. That's where the real pressure starts. Now let's zoom out for a second, because silver does not move in a vacuum. When silver behaves like this, it's often reflecting a broader question the market is asking. What is real and what is promised? In calm regimes, markets love promises. Promises are liquid. Promises are easy to price. Promises can be leveraged. In stressed regimes, markets pay up for what can't be printed, rehypothecated, or smoothly rolled. That doesn't mean everything becomes gold and silver forever. It means the risk premium shifts. It means confidence becomes a tradable variable. And silver, because it sits at the intersection of monetary psychology and industrial necessity, can become a surprisingly loud signal. That's why you're seeing mainstream narratives scrambling to explain it after the fact. But that's not the part that matters. What matters is what happens next in the real economy layer. If silver stays elevated, industrial players face a decision. Some will hedge more, some will thrift, some will delay, some will secure supply contracts. Those behaviors can feed back into the market structure because hedging flows affect futures, and procurement urgency affects physical premiums and deliverability stress. Meanwhile, in the portfolio layer, if silver continues to act like a high volatility risk asset and a hard asset hedge at the same time, allocators will be forced to rethink their playbook. That's the repricing of risk. It's not a speech. It's a shift in what portfolios have to do to feel safe. And that's where the pressure starts. Now, I'm going to give you a simple checklist for the next week, and I want you to actually use it. 1, watch whether silver can hold above the prior breakout zone after the next big volatility event. Don't assume the next big volatility event when date T come. This market is built to deliver them. 2, watch the curve behavior, nearby strength versus deferred, and whether front-end stress relaxes or persists. 3, watch implied volatility. If volatility collapses while price stalls, that can be a sign the market is transitioning out of squeeze conditions. If volatility stays elevated and price holds, that's a sign the market is still paying the tax and refusing to retreat. 4, watch cross-market confirmation, gold stability, industrial metals response, and broader commodity tone. 5, watch narrative timing. When the "it's over" story lands, ask yourself if it's arriving at support or in open air, because the market loves to deliver the most convincing narrative at the most emotionally vulnerable moment. That's the trap. And that's not the part that matters. Here lies the risk framing you need to hear, even if it's not as exciting as a moonshot. Price can whip around violently, even if the thesis is correct. In fact, violent whips are often how correct theses express themselves in crowded, leveraged markets. Trend signal is the ability to reclaim and hold key zones after stress. Noise is the intraday chaos designed to force emotional decisions. If you can separate those two, you stop donating money to the market's emotional toll booth. And you also stop getting baited into all or nothing thinking, which is the number one way retail investors get broken in metals. Metals are not linear. They are episodic. They compress, they explode, they retrace, they retest, and they punish anyone who needs the market to behave politely. And that's where the real pressure starts. Now let S close the loop on the core claim. Silver S breakout is forcing markets to reprice risk. That's not poetry. That's describing a system under stress. When silver trades at elevated levels with extreme implied volatility, hedging becomes expensive, margins become painful, and the financial system's appetite for risk gets tested. When the curve and the front-end behavior signal time is becoming expensive, that's a physical market whisper that paper can't fully override. When retail isn't even the loudest buyer and the move still persists, that suggests deeper flow sources and structural drivers. When cross markets start responding, that suggests the repricing isn't contained. Put it together and you don't get certainty, you get a map. And in markets, a map beats a story every single time. So here's my non-begging CTA, because the people who make money in metals aren't the loudest, they're the most disciplined. If you're the kind of investor who would rather understand the mechanism than chase the candle, you're already ahead of most of the crowd. Stay with this community mindset. We don't worship price, we track structure. We don't panic on the flush, we check the curve and the behavior. We don't get seduced by one narrative, we stack proof. And over the next couple of weeks, if silver holds the breakout zone through the next volatility hit while the front end refuses to relax, you'll know the market is still being forced to reprice risk. If it loses that zone and can't reclaim it, you'll know the move is transitioning from repricing into digestion, or something uglier. 2 scenarios: clear confirms, clear invalidations. That's how you survive the volatility weapon and stay positioned for the real move. And if this one level breaks, the math changes.